I was an early investor when I was at Ignition at DocuSign. And DocuSign was, it looked on the surface to be a feature, like digital signatures on your phone. And a lot of people, it was hard to raise money because people were like, oh, Adobe could write that feature in like 2 seconds. Well, what my recommendation was then was you have to get out of the feature and you have to turn yourself into a platform. So then they added all the workflow stuff of sending signatures around and integrations with real estate processing systems and stuff like that, created a new category, and they turned into a platform. They became an incredibly valuable, orders of magnitude more valuable company than the companies that came along in the past.
Network matters a lot when you're raising your first fund. So from a GP's perspective, if somebody was asking me what's the ultimate fund size, I would first ask, what's your strategy? But also, what's your network? So, and I didn't know a ton of people that could write me $1 million check. And so I kind of went with, what do I know? What are the rounds I know I can get into as an angel? The deal flow's there, the track record is there. I know I can get into these. Now it became about like, what is my network and how would I get through to first close so that I can actually start proving that I can deploy other people's money.
Understand what your manager believes the stages are and pitch them when you're in their sweet spot. If you're pitching me before you have an MVP, I'm likely to say no.
So I ask 2 questions. Sometimes I just say, what's your end game? Because you could get any answer. They might tell you how they want to exit the company. They might tell you what they personally want. And then I do also sometimes ask, like, how do you... my name is Illig. I'm the GP at the Council Fund.
I'm Martin Tobias. I'm the general partner of Incisive Ventures.
So much to Dula for being the early backer of the podcast. For entrepreneurs at Faucet just starting out, forming a US LLC, a bank account, managing taxes, compliance can be a daunting task. If you're a non-US resident or a first-time founder who lacks the experience, knowledge to navigate the complex legal and financial landscape, it will be impossible for you to do all this. Dula is an all-in-one platform that simplifies the process of forming a US LLC, setting up a US bank account, and handling taxes, compliance for startups and businesses all over the world. Dula's mission is to democratize access to the US market and empower entrepreneurs to focus on building their businesses without getting bogged down by bureaucracy. If you're building a company, there's no better option out there than Dula.com. Hey guys, how are you? I hope you're doing well.
Hi, I bet.
Good.
I think let's get into it. Let's start with intros. Who is who? We'll go alphabetically. So Amber, then Martin.
Yes, my name is Amber Illig. I'm the GP at the Council Fund. This is my second time on the podcast, so really excited to catch up with both Advik and Martin today. I run a pre-seed fund that we just closed in last October. And we invest in B2B software built for essential industries like healthcare, logistics, manufacturing, construction. Before that, I was an angel investor, invested in 30 companies along the same lines, and then was also an operator for about 10 years, working from Fortune 500 companies like Eli Lilly and Apple down to seed stage, crossing over at Snap in the middle for an IPO. So that's a little bit about me. I'll pass off to Martin.
Hi, thanks for having me back, Advik. I'm Martin Tobias. I'm the general partner of Incisive Ventures. I'm a pre-seed fund. It's my second fund. I invest in B2B software that reduces friction at scale. Prior to this, I was a 3 times venture funded CEO with 2 IPOs, raised $500 million. As an angel, I invested in about 200 companies. I was a little bit more of a shotgun than you were, maybe, Amber. But in the last 4 years, I've been investing on this thesis, other people's money, and invested in pre-seed in 6 companies in the last 4 years that became unicorns, 2 just last quarter. So I really enjoy working with early stage founders and, helping them with what I saw as a founder and, my founder journey. And I'm really enjoying it. I think it's in my 25 years of investing, I think 2023, 2024 are going to be some of the best years ever to invest in startups.
Like Martin said, I'm excited about 2023 and 2024 and think it's going to be one of the most incredible times to invest, kind of like 2008, 2009. But, even in these like micro hype cycles we've seen, like with Web3 and AI, when everybody's like, this is it, this is the future, I'm going all in. You just see a lot more founders, and it is hard to tell who are the ones that are going to be still standing here. And 12 to 18 months or 24 months that really want to go through the trenches to get there. So, yeah.
How much of what do you guys think that what you both invest in, how much of it will really be able to become a company that eventually becomes sort of like big tech? Is that possible?
I think that's the future. So I think personally, like, I think we've seen a lot of proliferation and almost like founder pollination from IPO events. So we saw like a ton of consumer apps have a lot of success. We've seen a lot of general horizontal SaaS have a ton of success. Every time a company goes through an IPO or a major acquisition, not only does the founder make a lot of money, but the employees make a lot of money, or especially the really early ones. If things are set up right, you can't always count on it, but it does happen a lot. And then a fraction of those people are actually going to leave and start companies. And so we're just starting to see that happen more and more in these legacy industries that cross over to tech, like Flexport, for example. I've had weeks in the past year where like 5 different people that just left Flexport are launching companies. And so I'm just really excited to see more of those. I think Anduril is another like huge success, more in the defense space. And there are just a few other examples, even One Medical, which is less vertical SaaS, but it is a vertically focused healthcare company. There are a ton of people from early One Medical days doing exciting things now after their $4 billion acquisition by Amazon. So I think we're going to see more and more of it.
Yeah. I mean, the funny thing about venture is that, I got to believe that every check that I write is into a company that could, be worth $1 billion. The reality is very few of them are going to be, but you got to kind of believe that the opportunity is big enough at the beginning. And that, we all know the reality is not going to turn out that way, but you've got to have it, be have that sort of potential in the beginning. Now, are they going to become Microsoft and, Google and Airbnb? I don't know. Those companies are, companies that end up being platforms, and many times it's unclear. What I tend to look for is companies that are creating somehow a new category, if we can. So, for example, I was an early investor when I was at Ignition at DocuSign, and DocuSign was, it looked on the surface to be a feature, like digital signatures on your phone. And a lot of people, it was hard to raise money because people were like, oh, Adobe could write that feature in like 2 seconds. Well, what my recommendation was then was you have to get out of the feature and you have to turn yourself into a platform. So then they added all the workflow stuff of sending signatures around and integrations with real estate processing systems and stuff like that. And they were able to migrate from a feature to a software feature to a platform. And in fact, they were the first platform, and obviously other people copied that platform, but because they created a new category and they turned into a platform, they became an incredibly valuable, orders of magnitude more valuable company than the companies that came along in the past. So I tend to look for those things that could potentially be the early leader in a definer of a new category. I just invested in this company called Tangibly, which is creating workflow software around managing people's trade secrets as opposed to patents. And basically, there's nobody building trade secret software. There's lots of people building patent workflow tracking software. If they can convince companies that they need this additional thing that they didn't know they ever needed called trade secret software, and that it's valuable to do that, and they're the leader in that category, you can create a company that's an order of magnitude more valuable than other companies because you created the category.
Yeah, I completely agree with what you said too. Your point about like, you have to believe as a VC that every single company is going to have this potential. And you might even want to believe that that could be a $10 billion company someday, which is totally aggressive. But I don't have any companies in my portfolio that like the day I invested in them, I thought, this might be a $300 million acquisition or $50 million acquisition. If that is in my head, it's automatically a no. And so, yeah, exactly. Venture math, like when you really do the portfolio constructions, it's tough. Like you have to be extremely selective and you have to believe that that's just, a possibility for every single one.
Is portfolio construction easier to do with smaller funds like you?
I personally think it could be, I think it's hard at every single stage personally, but it's just very different because as you if you're really early stage, you're really focused on pre-seed and seed, maybe a little bit of follow-on at Series A. But growth stage could get a little bit more complicated because you have to do so much follow-on to make sure that you're going to get the ownership that you need. Or you're like investing right before it's like going to go IPO in future years. So it's a completely different job because later stage is like so based in data, and early stage there's still so much feeding into it around the founding team and some of these intangible things. And you have some data, but it's not really enough to be making this sort of decision. So portfolio construction kind of changes a lot as a result of that. What do you think, Martin?
Yeah, I mean, the portfolio basically your fund size is your strategy. And in a pre-seed fund like mine, that's a small fund, you have to make enough bets that you have a probability of catching an outlier. And in my case, that's 30 checks out of the fund. You know, there are pre-seed funds that try to do 100 investments or 150 investments, but there's always a balance between check size and the number of checks you can write out of the fund. But there is a math you have to apply. You know, Series A funds, I mean, well, if they're a multi-stage fund, they might have more, but most Series A $100 million funds would have a much more concentrated approach. They would want to have only like 10 companies in a $100 million fund because they make bigger bets. And as you get later stage, you got to get more concentrated in your bets, or you have to have a giant fund so you can afford to make a large number of bets. But the interesting thing, the reason I started my fund is that, you know, when I first started investing in this thesis, I was doing it as an angel with a syndicate and other things. And I had made between 2019 and 2023 about 66 investments with an average check size of $40,000. And the MOIC was 2.8 and a 32% IRR. And you go, that's pretty good. Well, yeah, it's pretty good. But one of the things I did is I back tested it and I said, what if I had written a larger check, $250,000 across exactly the same selection criteria and exactly the same deal flow? What would that be? Well, that would have been an 8x TVPI and 112% IRR. So what that told me is that I needed to increase my check size earlier, and in order to get, you know, a really high alpha performing fund. And if you have good deal flow and good decision criteria, that would lead me to want to write a larger check sooner. But that's just a decision each manager has to make based on what they're really good at and what their prior track record is and stuff like that. But definitely, you know, you should play to your strengths, and in a smaller fund, you should have more bets, but you need to make the bets big enough to what that becomes an outlier to really capture and return the fund. Like, for example, I made an angel investment in OpenSea in the pre-seed. I only put $10,000 in. The last round was 13.8 billion. It was 240x. If I had written a $250,000 check, it would have been a completely different outcome.
Yeah. Another thing to take into account with portfolio construction too is like whether you're going to follow on or not. And at pre-seed, the answer does tend, like most of the time, to be more simple. At least that's what I've found, especially in the more concentrated model. So I also invest in 30 to 35 companies with every fund, and it ends up being like 10 per year. Currently, I'm not following on right now because you can actually, there's basically a lack of data sometimes between pre-seed and seed that's meaningful enough. And so you're kind of investing in the same company. And sometimes it's a really fast follow-on too. So like I've invested in a company, Resell, I think it was like last January. And literally 3 months later, Craft Ventures came in, led their seed round at like a 2.5x markup from where I'd invested. And, you know, I looked at it and I'm like, this is basically the same company. The only difference is that now Craft Ventures is involved, and that's driving up the valuation, and they see the potential in it, which is amazing. But those are the sort of situations you get in as an early stage investor. And so reserving, like, it doesn't always make sense to reserve like these huge amounts of capital to follow on in these investments because, you know, there's just not enough time that passes between the rounds. So a lot of folks are starting to just get as much ownership as they can early on and then ride it out and support the founders in other ways.
Yeah, I actually think the superior strategy for a sub $20 million fund is no reserves. And because then you get more shots on goal. And the trick is to get more shots on goal with a large enough check to make it meaningful if it turns out to be one of the things. mean, not so many like, you know, if you were writing $50,000 checks out of a $10 million fund, it'd be much harder to return the fund than if you're writing $250,000 checks. So check size has to be big enough. But I actually am a big fan of no reserves in pre-seed funds. Now you can, you know, do SPVs and other things to continue to support your founders, but you really are, you know, creating companies that Kraft is going to want to invest in, and you're just along after that. The other thing that happens if you have a multi-stage fund, if you have like $100 million fund and you try to do pre-seed, is that it actually makes it harder for you to raise that seed, because if you have the ability to write the seed and you don't, then Kraft looks at it and says, why didn't they write it? And there's a negative signaling. If you're just doing pre-seed first checks, there's no negative signaling to any seed funds that you're not following on because you don't have reserves. And it's a much cleaner story.
What do you think, in accordance with that, what do you think is the best fund size versus the worst?
Best versus worst fund size. What do you think? I'll let you go first.
Well, I mean, it just has a lot to do with what your own, you know, personal strategy and goal is, you know, as a manager. You know, I personally, you know, like the small fund size and like the pre-seed because I think I have an advantage there. I think small sub $50 million funds are amazing because they're easy to deploy and you don't need a lot of partners. I think the worst fund size is 150 or 100 to 300 million. And the reason it's the worst is that you have enough money where you need to write big checks in the seed, but you don't have enough money to follow on to the A or something. And you're competing for exactly the same rounds that the $1 billion multi-stage funds are competing for. And I think it's really hard to compete for those in a sub $50 million fund. You're fundamentally not in competition with the large AUM funds. If you look at all the unicorns that have ever been created, this is PitchBook data, basically 78% of unicorns were funded by a tier one firm in the Series A, and less than 5% were funded by a tier one firm in the pre-seed. And what that tells you is that those tier one firms, those multi-stage firms, they simply can't do pre-seed. The checks are too small, the deal flows too much, whatever. So there's less competition. You're much more collaborative. So personally, for me, I like the small fund size. I think the middle size is a dead zone. And the big size, it's pretty hard to be one of those firms because there's already so many of them. You know, I know lots of great partners at those funds, and, you know, they get a lot of money in fees. Another issue, you know, is, you know, related to your own manager's own personal ability to sort of live relative to the management fees. You know, one of the hard things in a small fund is you don't have a lot of management fees to pay yourself or a team or anything like that. So, you know, I'm the largest LP in my fund and I'm not living on my management fees. Not every manager can do that. Sometimes people raise a larger fund because they need the management fees to, you know, pay their mortgage.
Yeah. I would say we kind of already talked portfolios construction. So the other lens I'll take with this is network matters a lot when you're raising your first fund. So from a GP's perspective, if somebody was asking me what's the ultimate fund size, I would first ask, what's your strategy? But also what's your network? So for me, I was coming out of the operator world. And so I knew a lot of angels and operators and people that had gone through like medium-sized liquidity events, but I didn't know a ton of, I knew 0 family offices, to be clear. And I didn't know a ton of people that could write me $1 million check. And so I kind of went with, you know, what do I know? What are the rounds I know I can get into as an angel? You know, the deal flow is there. The track record is there. I know I can get into these. Now it became about like, what is my network and how would I get through the first close so that I can actually start proving that I can deploy other people's money. And so that's why that's one of the reasons I chose a smaller fund size, and it made sense for me. And then the second thing about like, what's the ultimate fund size? There is no right answer because it's different for every GP and where they are in their journey. So from an LP's perspective, they also view fund size over time as like a stepping stone journey. And so it's a red flag to them if they see somebody maybe coming right out of the gate being like, I want to raise $100 million, or they do a tiny fund and then all of a sudden they want to raise $100 million overnight. because you're running a different type of firm as you step this up. Like the team that you have around you as a GP is going to be a lot more hefty if you're going from participating in rounds to leading rounds and doing more due diligence and providing platform services to the companies that you invest in. It goes from like having communities and brands to all of a sudden having like full-blown programs running. And so that's something LPs have to believe you're ready to make that jump also as like a leader and almost like the CEO of your firm, not just an investor. And so that's something to consider. And then in terms of ultimate fund size, Martin kind of alluded to this already, but funds under 100 million are known to outperform. There's a lot of data around this. Like when I started my fund manager journey, people were just talking about it with anecdotes, but now it's like there've been multiple reports run that show that funds under 100 million tend to outperform. And my guess is if you got more granular, the smaller you go, the better the performance gets, even down to like micro and nano funds. And it's for a lot of different reasons. One of them being, if you're raising a huge fund and you have a tiny team, you're getting a ton of management fees. You might be making like $1 million a year just in management fees. So you don't have as much of an incentive to produce incredible returns for your LPs because you're going to get, this incredible paycheck for the next like 4 to 10 years, depending how you have it structured. And you'll probably raise another fund on top of that will layer onto it every single 2 to 3 years. And so the incentive alignment is really there the smaller you are. So I wouldn't say stay small forever because it's not sustainable for a lot of people and you're limited in terms of what you can offer founders as you grow. But I would think about like stepping stones over time and not trying to go too far too fast.
Do you think you guys will grow your fund size?
I will not grow my fund size. I mean, I'm, at the end of my career and I will do $10 to $20 million funds, maybe 2 or 3 more of them just in the pre-seed. I don't want to create a generational firm. I don't want to have partners. I'm just going to continue doing what I'm doing. I know a lot of younger managers are going to want to grow their fund size.
Yeah, I would say I'm on the flip side of that. So I'm definitely wanting to create a generational firm. I'm hoping, I have multiple decades left of this job. And so definitely wanting to grow my fund size in the future. But that said, I want to be reasonable about it. And I'm really motivated by that data set that says that funds under 100 million outperform. So I'm not trying to build like a multi-billion-dollar firm anytime soon. Like things could change about the market or, different learnings that I have. But I think the more important opportunity is to kind of be more involved and helpful to founders as they're getting from pre-seed to Series A. Because right now, frankly, like Martin is completely right. Like at pre-seed for sub $20 million funds, it makes sense to do like one check-in and then not follow on at all. But what I see is a lot of founders, especially in these more legacy industries that are building software that not all VCs understand, it can be really nuanced. They need more support sometimes just in like getting the belief and the network together to get through seed and Series A. So I've seen, founders with incredible credentials, both in high growth tech companies and in legacy industries, with incredible technical backgrounds. They have trouble raising money at seed because not that many people understand supply chain and logistics. But once they get their numbers working by like Series A, people start flooding in and trying to like preempt the round and get introductions to them. And they almost have to keep them at bay because people know how big those industries are if you're doing something that's proven to work inside of them. And so for me, I think there's this opportunity to really be a partner with these companies as they grow from pre-seed to Series A. And even though it doesn't always make sense from a portfolio construction, it could be viewed as more like gravy for the fund to actually follow on at some point at seed and or Series A, especially Series A because there's more time that passes between seed and between pre-seed and Series A. But yeah, I do think there's an opportunity like to step away from what's popular right now and do something that's more helpful for founders long term.
I think if we take a step back and get the nomenclature all set up, what do you guys think? What is pre-seed? I just throw it.
Well, I mean,
loaded question.
It's a loaded question. Everybody defines it differently. I actually wrote a post about this on my blog, and you might put it in the show notes where I define angel, pre-seed, seed, and A. And the interesting thing is that the bars for each one of those changes over time, and you got to kind of stay up. But my definition, and intelligent people can disagree, but is that the angel round is where the company's raising around less than $500,000, has not built an MVP, is at the ideation phase, and wants to build an MVP. I define pre-seed as starting once you have an MVP in the market for 3 months, you're starting to generate some revenue. This is all for B2B software. It might be different for hardware or drug discovery or something like that. You're raising between $500,000 and $1.5 million. You've got $5,000 to $10,000 a month of revenue. And then seed tends to start around where you've got $400,000 or $500,000 of ARR. You're raising $3 to $5 million. Then Series A is now up to starting at around $2 million of ARR, and you're raising $10 to $20 million. Now, those ranges can change over time, but I define pre-seed, institutional pre-seed, as starting after the MVP is written. There's plenty of VCs that'll say, we'll invest in ideation stage before the pre-seed, and you'll see $2 million pre-seeds happening. They tend to happen from, incredibly well-qualified founders, and like a 3 or 4 person founding team where they have a high degree of confidence that the MVP is not going to be a problem, or that the first customers are not going to be a problem. You'll see sometimes people skipping the angel and going straight to a big-ish pre-seed round. I'll look at those too for high qualified teams, but I tend to want to wait. And the reason is because in my mind, the pre-seed is all about getting product market fit and getting to $500,000 ARR so you can get a seed round done. And until you engage with customers, I talked to a guy, I wrote a tweet about this yesterday. They wrote an MVP. They got it in 3 POCs. I said, what's the response from the POCs? And they said, well, all 3 of them want me to build 3 different features that I haven't built yet. They didn't care about the features that they'd built right now. They wanted a completely different product. That feedback of, did you build the right product in your MVP, is incredibly valuable. And it determines in large part how much money you have to raise in your pre-seed to see how much features you have to build in order to get to that $500,000 ARR number. They had like $5,000 MRR from POCs, but the POCs wanted all something different, which means that those POCs are probably not going to convert to full paid customers until they write a whole bunch more software. So the size of the pre-seed round is many times determined by the feedback from the initial customer interactions. If you don't have customer interactions, you're raising a pre-seed without knowing how big it can be. That's why I define pre-seed as after the MVP.
Interesting. For me, I think about the way that I name these stages. I personally, understanding everybody does it differently, I think about it in terms of milestones that get unlocked. And some investors do think about it as like, what is the valuation range? What is the round size range? For me, it's what milestones have been unlocked. And then the valuation is kind of like does it make sense with the market type of question after that. So the 3 milestones I look at are like product, like is a product built already? Is there revenue coming in already? And is there real traction? And where pre-seed and seed exist on that are a little bit different. So for me, I bucket together angel round and pre-seed because technically I would consider investing in both. There've been like 8 situations even in this current portfolio where I was first check-in and ended up being a catalyst for a round, and there were no angels before me. And so I bucket those together. And so it could be pre-product, it could be pre-revenue, it could also be pre-traction. It most definitely is pre-traction. But in order to invest in a company that is pre-product, I have to at least see like Figma files, and I have to know that a lot of work has gone into understanding what it is that the customers need. So maybe this founder spent like 6 months doing 100 interviews of people and they have LOIs ready to go as soon as they can finish building their product. And then LOIs like letter of intent for anybody listening doesn't know that. But it's somebody saying, hey, I will pay for this once it's built because it meets my needs. So that sort of thing I'll consider. But also like the earlier I go on that continuum of pre-product and being first check-in, the more I really have to trust the founder. And many times it is a founder whose operating experience I know very well or founding experience I know very well. And so sometimes if I'm still getting to know a founder, but I really believe in them and see what they're building and I'm really excited about it, I'd rather see a little bit closer to like early revenue. So it really depends on the deal, but it's for me, anything between pre-product to early revenue.
Understand what your manager believes the stages are and pitch them when you're in their sweet spot. If you're pitching me before you have an MVP, I'm likely to say no. And I just tell people that. And so that they know, right? Unless you're an exceptional founder that I already know, that I have a high degree of confidence, like maybe your MVP is like 2 months away. I mean, I would consider that too, but in rare cases. And Amber has a different decision factor. you need to understand what that is to pitch, her. So I don't want to get caught up on it. I don't think there's no right answer, because at the end of the day, buyers and sellers have to meet and agree on something. One of the things I pay a lot of attention to, though, and one of the reasons I tend to not be the first check-in, is that I want to be an investor in a complete round. And, I talk to people, and, I talked to a guy yesterday. He's like, I'm raising $1.5 million. And I'm like, how much have you closed? 0. Do you want to be the first check? Well, I look at what you want to spend $1.5 million on and how much code you have to write and blah, 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 blah. And I'm like, well, I like what you're building, but, you're going to need the whole $1.5 million. And, if you don't raise $1.5 million, my money will have been wasted. I talked to another founder a couple of weeks ago, and they're saying, we're raising $1.5 million. I go, great. How much have you raised? $750. How much did you spend? $600.
Wow.
So it's not $1.5 million raise. It's in fact 150 plus 750. It's like a $900,000 raise. So you can't just take the money and move out the runway, right? You gotta, my question is always, how much runway do you have from the day I write my check, right? And I want that to be as long as possible. If you're burning, $50,000 a month and I'm the first check for $250, you only have 5 months worth of runway, unless you have more money. You don't have 12 or 18 months worth of runway. I don't care how big you say your round is, right? So I pay attention to that. I want to give companies enough money to achieve a reasonable set of expectations. And these hand-to-mouth fundraisings where you're raising $50,000 every month on a rolling basis, they're really hard for companies to operate, and they're even harder for investors to get behind, because you're not giving them a material amount of runway.
Yeah, I completely agree. That's a huge risk. I think because I run a huge operator network of angels that are at companies like Square and Slack and Airbnb and Lyft, seeing their company or their coworkers like spin out to start new companies, I typically have a lot of intel on people by the time I'm talking to them. And so I've had a lot of success being this first check-in. I think I did it like 4-ish times when I was an angel, and 2 of those are my most outperforming companies, Daybreak Health, and then another one that's still in stealth. And so I wanted to continue doing it as a fund manager, but I will say I've taken it too far at least one time where I didn't know the founder well enough. And I did write that first check-in, and it ended up being one of those fundraisers that goes on forever. And so that has been a lesson learned. I've gotten more strict with myself on the type of founders and traction, even in fundraising ability that I need to see before I'll write that first check-in. So, because it's a huge risk, and you don't always get it right, especially when you start saying, hey, if I just copy what I did with this person I know into this person I don't know, it'll do the same thing. That doesn't always happen. So that is why, like, as much as it annoys people, investors do sometimes invest in who they know, because you can trust them and you know what they're capable of. And you also know kind of what their network looks like and how many people are on the sidelines waiting for somebody to write that first check. So, yeah.
Martin, you've been in the VC world ecosystem for a very long time. I believe more than if I'm not wrong, like since the 90s. Do you think VC money was originally intended towards pre-seed or towards later growth?
Well, it was originally, the idea of venture is like a new company, right? Like actually what's new in venture is all of this late stage money that came in the last decade, really. I mean, guys like Tiger and Code2 and these giant funds, when I started in venture, when I raised my, first money, venture funds were $100 million funds, and there was like 3 of them in Seattle. And now there's probably 40 venture funds in Seattle. The amount of money in venture has exploded, and the amount of money at different stages has exploded. But the original idea of venture capital was, high risk capital for new ideas that nobody else, would fund at the very beginning. What's happened in the venture business is that it has fragmented into the different stages. And now, there are funds that just do late stage. There are funds that just do mid stage. There are funds that are just Series A funds. There are funds that are just pre-seed funds. And I think that's a good thing for the overall ecosystem. There's a lot more money out at a lot of different stages. than there was before. It's really great for the innovation ecosystem. It's pretty much anybody with a good idea. I mean, we're in a little bit of a more constrained environment. Prior, until like 2021, almost anybody with a good idea could get funding, and you could raise funding every 6 months. And we're back into a little bit more constrained environment, not because there's less capital, because there's still plenty of capital on the sidelines. It's because the bar on each stage has gone up. So I think that's also a good thing.
How do you guys decide the valuation at such a small stage, the starting stage?
I'll just say I don't lead rounds, and it's not because I don't have the faith to lead the rounds. It's because I have a small fund, and it doesn't make sense to have like a 50 to 100K check leading the round and setting the terms for everybody else to follow. And so for me, it's a little bit of a check the box activity. I'm trying to make sure that the valuation makes sense and is not a deal breaker for me, and will work with my portfolio construction. If I look at like the potential future value of this company after multiple rounds of dilution, if it goes through an IPO or major acquisition, would it be worth enough based on this starting point? So I kind of just try to keep an eye on the market, have conversations like this, look at reports, understand where the market is heading. I do not want to be the last person that comes into a pre-seed round that's had like stacked safes where the round valuation just keeps going up or something like that. I like to be early, but make sure I'm participating in a full round like we talked about earlier. But yeah, it's a range for me. Like I'm not nickel and diming companies on that necessarily, or saying like I can only invest if it's 7, not 8, or 8, not 9. So it really just depends. I will say I've had this weird observation that I haven't seen. Like sometimes when I'm in conversations like this, everybody's saying pre-seed valuations are going down. Actually, when I think back to 2021, I saw a lot of pre-seed valuations around like 5 million posts with some early traction. And now it feels like the magic number is like 8 million posts. And it could be the network of founders that I have access to is able to command that valuation. But I'm curious what you're seeing, Martin, in terms of valuations.
I'm still seeing high quality teams able to get a premium. But like I track this, and until like the middle of last year, the average deal that I did was valued at $10 million. And from November, middle of last year till now, the average valuation is $6 million. So my pre-seed valuations have gone down about 40%. There's still some outliers. The king of outliers is fucking YC. I mean, I talked to the YC companies, and you had pre-product, revenue, pre-anything companies trying to raise 5 on 20 because they went to Stanford GSB. And some of them raised money, and, more power to them. The unfortunate thing is that I've also seen, YC companies from 1 or 2 batches ago raising a flat round because they, the market at seed is 20 and they raised a pre-seed at 20. So I don't participate in those rounds that I think are disjointed on the stage. I may miss some that way. I'm not, completely hardcore on valuation, but I have seen pre-seeds come down a little bit in valuation. But the more important thing that I've seen, which I think is better, is that I've seen the pre-seed round size go up, because you've got to go farther to get to a seed. Until 2 years ago, the seed, you could get a seed done with 200, 300,000 ARR. Now it's 400, 500, 600,000 ARR. So you've got to there's an understanding that you got to have a slightly bigger pre-seed. When you could raise money every 6 months, you could raise 12 months of money in your pre-seed and, be pretty confident to be able to get there. I am only participating in pre-seeds today that provide 18 to 24 months of money, because I think it takes longer to get that next round done, which means the round has to be bigger at the pre-seed. So even if it's 8, instead of a $750,000 round, maybe it's $1.5 million round.
Yeah. That is what I'm seeing. It's more like 1.5 to 2 million on an 8 million post. It tends to be typical. And I'm still seeing some 5s and some 10s, but very few over 8 at this point. And that
I would be happier. I would be happier doing a $2 million round at 8 than doing a $1 million round at 5. I'm a co-investor as well. I tend to not lead. I've led 1 or 2 rounds. I just do the same thing. I just check to see if it's reasonable relative to comparables I'm seeing, relative to the quality of the team, the traction, this and that, and the potential, return multiple. I've invested from $3 million up to about $16 million. So I don't have a hard number. It just relates all to the, traction, team relative to valuation type equation. It's a little bit more of a art than a science. But yeah, and I tend to pass. One of the good things that's happened, is basically until the middle of last year, or maybe till the end of 2022, VCs were very much in a price taker scenario. Companies said, here's the terms. People knew deals were going to get done, and you basically accepted the terms or not. And frankly, in the last year and a half, there's been a lot more flexibility to negotiate terms and to come to an agreement. Companies have been more willing to want to discuss what the market is. And I've had many conversations where the company comes in and says, we're pre-product, pre-revenue, we're raising 1 on 10. And I said, I think it should be 6. And they're like, well, let's talk about it. And then they talk to other investors and everybody else says 6, and then they change it to 6. So, I think companies are more willing to, have the valuation discussion than they were before. And I think that's better for everybody. And there's a little bit more mutual agreement versus just being a price taker.
Yeah. And I think I love to do this market comps. And I also have this understanding that the market is always moving. It's very analogous to the housing market, because it's like, you might be looking for a house and like 6 months ago, it would have been a different price, than it is today. But right before you make that offer on the house, you want to do exit comparisons to see what were people paying for houses on the same block, like in the past 30 days or 60 days, because I don't want to get the worst deal on the block. And also they're just things that are completely out of my budget. So I'm going to just knock those ones out to start. But if we're getting closer to the budget and the deal range that I'm comfortable with, now I just want to make sure that whatever's happening is fair. So, yeah.
How does the team, how does the quality of the team really correlate with the valuation that Martin was talking?
Yeah, I think some teams do command a higher valuation because they can, but it's not massive. It's not like, well, unless they're going through YC, but a lot of times it's like, 1 to 2 million in flex in terms of the post-money valuation that I see. Yeah, it doesn't make a huge difference. It's almost like there's a range for pre-seed, there's a range for seed. A couple things can knock that off its rocker, but yeah, it seems to, it makes a little difference, just not a ton.
Yeah, but then the thing is, in pre-seed, I have a different decision criteria for pre-seed versus seed, but in pre-seed, it's all about the team. Like the team in my model is like 70% of the investment decision weight. And, because that's a lot of times, almost all you have is the team. You might have a thesis on a product that you're going to build. You might have a little bit of customer traction, but it's really all about the team. And so, what I try to do is just invest in the best quality teams that I can at reasonable prices. And I do pay up for better teams. I've talked at this point in my career to well over 10,000 founders. And I can tell within the first 10 minutes of meeting a founder, are they in the top 5% of founders I've ever met in my life? And if they are, I'm going to be very interested in talking to them more. I try to invest in sort of the top, and VC is a pattern matching game, right? And you're trying to say, does this person or team in front of me match a pattern that I've seen be successful before? So for me, the team is the vast majority of the decision factor in making an investment, and the price is less important.
How much of it would be for you? How much of what you invest in Amber is dependent upon the team? For Martin,
oh my God. Like whether I invest and whether I think it's a good deal, it's probably like 90% of the, maybe not 90, maybe like 70, 80% of the deal, because the thing about pre-seed is you're investing in a person, maybe a tiny team, an early product, and a market and a vision. Like everything is on paper. And while I like to know that there's a plan and there's been a lot of thought put into it, I know that a lot of things could happen along the way. And this person might need to pivot. They might figure out in the next 6 months they don't have product market fit, and they might need to make some big changes. And so I'm investing in the captain of the ship, believing that they're going to be able to navigate those storms. And so that's why it's so important to make sure that that team is solid on a lot of things. Like, are they able to do founder-led sales? Because they're probably not going to have an official sales team for a long time. Do they have a strong product vision? Do they want to be working on this for the next 10 years of their life? Or is it a get-rich-quick scheme? Like, there's a lot of different questions I go through. And the 3 biggest things for me are resilience, mission, and vision. Resilience, I like to know from prior experience. They've been through the trenches before, whether that was starting their own startup in the past, or working one of these legacy industries really, really hard and being one of the best people in their field, or working inside of a high growth company that demands a lot from you. I like to know they have thick skin, so this isn't going to be a total shocker walking into the ambiguous world of a startup. And then mission, I like to know that they have a personal connection to what they're building, because I think, again, if they don't and things get tough, they're probably going to give up. And then the third one is vision. So I just want to make sure that they really see the world differently with their product in it. And it's not just like a widget or a feature or, this cool idea that could take off in a year, but not really like a longevity in the plan and the full vision of it coming together. So that is like number one thing I focus on in the first call is just, who is this person running this company? How much have they thought through and planned? Do I agree with that vision? And do they have these 3 attributes that I'm really looking for? And then I get into the checklist of all the other items. But yeah.
How much of it is dependent upon the track record that the founder?
I'm not as worried about the track record as I am about their ability to deal with resiliency and change and decision-making factors and stuff like that. Because, people can say, oh, I was at Stanford GSB and I worked at Meta and I worked at Amazon, but you were an individual contributor the entire time doing a very small focused thing. And now you're going to be wearing 25 hats. Prove to me you have worn 25 hats and you love the challenge of doing 25 hats. I hired this guy one time when I was at Anderson Consulting, and he was an MIT PhD computer science guy. And we hired him as a programmer, and we put him in bug fixing. And bug fixing was terrible for him because he was like, I'm an expert in all this kind of programming, but I have to read somebody else's code and fix somebody else's shitty code. And he got completely tilted and couldn't handle fixing somebody else's code, because he's like, well, if I had written this, I would have written it completely differently. So he didn't like the, having to solve other people's problems. That was not his superpower. And we ended up having to fire him despite being an MIT PhD, because he was terrible at the job we asked him to do, which was, new problems every day. So I focus more on that is, how good are you at, operating in an uncertain environment with low information and pivoting and making good decisions with limited resources?
Yeah. I don't need to see that they've founded a successful company in the past. If they've founded any company at all in the past and put significant time and effort into it, that's super impressive. And the fact that they want to do it twice is also very impressive. But they don't have to be an ex-founder in order for me to invest in them. I like to see that they have some operating experience, whether it was as a founder or an early builder somewhere. And by early builder, I mean, it could have been seed stage to Series A, or they could have been at growth stage when they were just at a company that was growing rapidly and they were in a really critical role. So one thing I realized when I worked at Cruise was every single company or every single quarter was kind of like the whole company was growing into a whole new beast. Like, I was there at a time where we were growing from 400 employees to 2,500 and making some huge technology bets. And so it was just interesting to see how the company reacted to that. And as a people manager at one point, I would interview people for the job, or I'd even have peers join the company and see them come in. And some people just couldn't handle that. If you get the rug pulled out from you every quarter because we're doing an org change because we need to grow and we need to attack this next new frontier in front of us, probably not going to survive in a startup, and you're most definitely not going to survive as a founder. Figuring out I feel like founders get bad news every day. It could be something in the back office. It could be anything. So you need to be resilient and able to just handle that. You're creating solutions out of complete white space, which is uncomfortable for a lot of people. B, a lot of times it doesn't work and you have to keep iterating either on a micro or macro level. So that just takes a certain type of person that can and wants to deal with that.
How do you identify those people?
I do not care what college somebody went to, and I don't care whether they have an MBA or not. Like for me, that's less exciting than like, what have they really worked hard at in the past and what have they had to go through to get there? So, grit is grit, whether it was like you launched your first startup or you worked for somebody else's. If you were entrepreneurial enough to join early and see a lot of things happening from the inside, that's exciting to me. So I like to understand founders' backgrounds, and I typically ask, why are you building this company? And that typically brings up a lot of things about like things what they were doing prior, what sort of things they realized around them. We can get into, what was that like and what did you like and dislike about that experience? And that kind of tells me a little bit about what I'm getting into in working with them. So,
well, I really want to figure out, are they a good, problem solver in a low information environment? So, I just asked him about that. I asked him that question. I said, why are you starting this company instead of any other company you could potentially start? And, tell me about a, big challenge you had in the past and, how did you get through it? And sometimes I'll even do things like, I'm a big poker player, and I'll go play poker with the CEO, and I'll see how he makes decisions in poker. And how you make decisions in poker is very indicative of how you make decisions in business. Are you a risk taker? Do you take calculated risks? Another thing I'll do is a question I'll ask is I'll say, what kind of car, do you want? What is your aspirational car? I remember I asked this one founder one time, he was a CFO, and I asked him, what's your aspirational car? And he said, it's a Porsche Boxster because it's a practical Porsche. It's the value Porsche. And that was a huge red flag for me. The answer I want from the CEO is, I want the Porsche Twin Turbo GT3, the fastest fucking Porsche in the world, the most expensive, craziest Porsche in the world. That's what you want your CEO to say. You don't want him to, you want him to be a risk taker, to have big aspirational goals and be a little bit willing to take risks to get those goals. You really don't want the CFO type things, which is incredibly pragmatic, all numbers based, because in a startup, you got to make leaps of faith, bets based on, a vision, a mission, and all of these other things. So I try to ask them questions that say, what's your tolerance for taking risk? And are you good at making decisions in a low information environment?
That's a high pressure poker game. Yes. As a non-car person, I don't know if I would interpret it that way. I think I might interpret, if they said they want like the ultimate Porsche, I might interpret it as they're too money hungry. And that's their key motivator versus making a huge splash in the industry and like changing the game. But a lot of times those things go hand in hand. So
living your personal life, like living below your means, is an incredibly good trait. And I also want that from my CEOs, but I want them to have aspirational goals, that where they want to do things and for the right, reasons. It's not just, sometimes that car question works, sometimes it doesn't. It depends on if it's a car guy. But there are other questions I ask too. But the nub I'm trying to get at is, do you have a big enough vision, and are you good at making decisions in a low information environment? And CFOs tend to be very bad at making decisions in low information environment because they need a lot of information to make a decision. CEOs need to be really good at a low information environment. And self-awareness, I
think if you're really a founder that's going to stick with this for the long haul and not the tourist founder, like aspirations are always massive. Like for the people that are successful, I don't think it's going down anytime soon.
The kind of aspiration I want is also, to your point, Amber, it's not an aspiration for a particular dollar volume. It's an aspiration for a better world enabled by the invention that I'm doing. And I am committed to bringing my invention to the world because I know it's going to help people in a particular way. and hopefully I'll make a lot of money doing it. But the aspiration to bring your vision of how the world can be better is much more important than the aspiration to make a particular dollar signs of money.
Yeah, that reminded me of a question I do ask. So I ask two questions. Sometimes I just say, what's your end game? Because you could get any answer. They might tell you how they want to exit the company. They might tell you what they personally want. And then I do also sometimes ask, like, how do you see the world in 10 years with your product in it? And if they say something like, so I invested in this company called Arvest AI, and they're building like a digital twin for distribution centers and manufacturers of warehouses to kind of predict, things that could happen with yield before they even happen. And I asked him, what's your end game? And he said, we want to replace barcode scanners everywhere. In 10 years, there won't be barcode scanners. I was like, okay, all right, I can get on board with that. So that's a good answer to that question for me.
Do you think do you think founders are naivety too when you ask these questions?
I don't think that they're naive. They probably know that they're extremely aggressive. But it can get into like delusional territory. Like they're extremely passionate about the spaces that they're building in, and they spend all day, every day in those spaces, and they know more than anybody on this call or anybody on any call with them does about their space because they're in it like 24/7. And so they definitely, like, the strongest founders have a point of view on the industry they're building in and how it fits the world. And that can, they have to motivate themselves. They have to motivate their investors. They have to motivate their teams. They have to motivate their customers to want to work with them. And so they're in like constant sales mode all the time. And for that, I think they do. I don't think they're naive, but I think they are extremely optimistic about what they're doing.
Right. And you gotta, as an investor, put on your discount hat and try to avoid the CEOs who are optimistic to the point of delusion. You don't want to invest in Theranos, WeWork,
yes,
this kind of thing. Adam Newman is a crazy, amazing salesman. He convinced people that a real estate company was a tech company. I mean, he had to be a fucking Svengali to do that shit. I saw their pitch deck. I never would have invested because I just said, this is a real estate company. It trades at a much lower multiple. And he had convinced people it was a tech company. In the end, it was a real estate company, not a tech company. But he was able to convince a lot of people that he was a tech company, and some smart people too. And, Elizabeth Holmes was able to convince people that she could do something that she was turned out to be lying about. So you want to try to avoid those, and that's a risk, in investing in an overly optimistic type CEO. That's the other side of it.
Yep.
How do you identify if a founder is being honest or not?
You can back channel and talk to other people, but you do this game long enough and you're going to make mistakes, and you're going to find some CEOs that end up not being honest. For example, I invested in a company. It was a fantasy sports gaming company. When I met the founder, he was a great guy, and references checked out and everything on it. It seemed honest. Looked at his numbers, all the numbers validated by Google Analytics, and everything was fine. He raised a pre-seed, then he raised an A at a huge up round based on huge growth in user numbers. And the Series A guy got a little concerned about the growth of the numbers because it was like 30% month over month, and had an audit done. Turns out the CEO had created bots to go to the website, and 90% of his users were fake bots that he had created. He had basically lied about his growth numbers. Now, it was hard for me to figure out in the beginning that he was a liar. It turned out he was a liar. And I mean, that could have been like how Elizabeth Holmes started, right? In the pre-seed, she probably wasn't lying about it, but by the A or the B, it turned out that she was faking it much more than making it. I want the CEO to have a little bit of fake it till you make it, but not too much, not switch over into that fraud category. And that's happened to me, once or twice. And you make enough of these bets, and that's going to happen, and there's nothing you can do about it. But you do your reference checks beforehand and try to, figure out their going in position. They might change, and it has happened.
Yeah. Yeah, it does happen. And I think it happens a lot more than people talk about publicly, because we hear about the ones that publicly blew up, but almost any VC you ask has some crazy situation that's happened in their portfolio, because everybody's kind of incentivized to keep it quiet when these things happen. The founder doesn't want it coming out. The investors don't want it coming out. So, yeah.
When I was at Ignition, we had a company that was growing and had raised two or three follow-on rounds. And they had not completed an audit for 3 years. And the board, and in early stage companies, a lot of times they just let that pass. But the board finally, after the B, is like, you got to fucking complete an audit. And the auditors came back and said, we can't verify the numbers. And what it turned out it was happening is that for 2 years, the CEO and the CFO were keeping 2 sets of books. There was actual books and the books they were reporting to the board. They were standing up in the board meeting every month and lying to the board. That's an incredibly difficult thing for board members to find out. And if companies do that, I mean, there's not a lot you can do. It was embarrassing for all the VCs and everybody, but it's also incredibly difficult. Like if the CEO is willing to look you in the face and lie to you, it's incredibly hard to figure that out.
What did happen after you guys find out that he was there?
In both those cases, the companies wound down and went bankrupt immediately, because the board basically fired the management team and returned the cash. They're like, this is a fake business.
Yeah.
Do you think will that, as more companies pop up, will that increase over time? Or
I don't think that'll increase over time. That's incredibly bad behavior. It's incredibly rare. Like in my portfolio, that's like 1%. And, you're going to have a, 60, 70% failure rate in your portfolio. Fraud is going to be an incredibly minor amount of that failure rate. The vast majority of failure is just not finding product market fit, not finding enough customers, people working as hard as they can, and it just doesn't work out. So the fraud is not a material amount of the problem in venture, and I don't think it's going to grow. Even the people that are doing it know that it's bad behavior, and I think the only people that do it are hoping that they can fake it till they make it. But when they cross that line to fraud, there's not a lot you can do about it. I don't think it's a growing thing. I think it's a minority. It's not an attractive thing. Nobody really wants to do it.
Yeah, I honestly don't know how people like that sleep at night. So, yeah, it's tough. I think that's why it's so rare. Like it would be hard to really look.
You're hard to live with yourself
about something like that. Yeah,
knowing that you're doing that. Yeah.
Yeah.
Pivoting a little bit, where do you think, as we get to last week, how do you guys think will pre-seed really grow in the future? Evolution
of pre-seed. So I think we're at this interesting moment where it has become quite popular, but the definition of it keeps shifting, as we talked about. So when I first started investing, actually, I'll say not when I first started investing, but when I first launched the council fund and started raising it, a lot of people wanted to launch pre-seed funds, and they're willing to invest quite early in these companies. But now I think we've seen this shift happen where a lot of former pre-seed investors are saying, hey, valuations at seed have come down a little bit, and they're kind of in the range of what I would have considered in pre-seed, or they're just above it. So why not wait and no longer invest at pre-seed and invest at seed, or invest at like a little bit later pre-seed and start asking that these companies get to like 300K ARR, call it a pre-seed round so I can get a good valuation or good price, and invest then. So I think there's a class of pre-seed investors that are now defining it as something that has more traction than previously. And then I also think there are a lot of Series A investors kind of doing the same thing where they're like, hey, I could invest at Series A, but I'm seeing that seeds are actually getting to the same metrics or closer to the metrics I wanted to see at Series A. So why don't I go into seed? So to me, like seed is now the super popular, super highly competitive space. It's really hard for people to lead rounds in seed stage. But I actually think there's a ton of opportunity for true pre-seed investors to get in and participate, get in and lead, and really support founders that are doing something different.
Well, seed is definitely the new Series A. As you've gotten a lot more capital in the venture capital and everything like that. Let me just give you an example. In 2003, when I was at Ignition, we led the Series A of DocuSign. And you used to not have pre-seed, angel, seed, and all that stuff. You just had Series A. Like that was the first round you did. The Series A of DocuSign was 4 on 7.
Oh my God.
That was a Series A. And today that would be a big pre-seed or a seed. And so, the names have changed over time, but what I like about pre-seed, and the reason I put an angel before the pre-seed, is that pre-seed is the first time I believe that the institutional funds might get involved in a company, different from angels. Angels will be like, they're just writing checks, but they don't have very much support for those companies, follow-on financing or anything like that. The thing I like about pre-seed is that there are now professional people like Amber and I who have funds that are built specifically to do those very early checks, but also to support those companies, to make introductions to seed rounds, to help with business development, to do a lot more work than an angel would do. So the thing I like about the pre-seed stage is that it has been professionalized. In some ways, it's like a super angel type thing. But, these firms do a lot more than angels have traditionally done. There's a pretty well-defined role to get them ready for these seed funds, which are the new A funds, basically.
Yeah. That's an incredible point, I think. This is incredible. I hope you guys enjoy it. I think we'll take a hard stop there. I think that's from my same thing in Illig.
All right. Well, thank you for the time. It was good to see you again, Amber. And let's, make sure we do a deal together in 2024.
Yes, I would love that. And thank you, Advik, for bringing us together. It's great to catch up again with both of you. So have a great day.
Yep. Thank you.